SpaceX is heading for a $1.7 trillion IPO, and most people have no idea what they're actually buying. Everyone is focused on rockets, Mars, and Elon Musk. Almost nobody is asking the question that actually matters. SpaceX today is not just one company. It's three completely different businesses stacked on top of each other, and they don't behave the same way. So which one is driving that $1.7 trillion? And more importantly, who ends up holding the bag? Let's start with the part everyone understands. Rockets, launches, satellites, NASA contracts, government payloads. It looks powerful, it looks essential, and it is. But the rocket business is not designed to scale like a software company. Every launch has physical constraints. Every mission has cost structure. Every contract has limits. Revenue exists. But it doesn't explode the way retail investors imagine when they hear space company. But that's still not the real problem. So if rockets aren't the engine of exponential growth, what is? Starlink. This is the business most investors quietly care about. Satellite internet, global coverage, military contracts, a network that doesn't depend on traditional infrastructure. And unlike rockets, Starlink actually scales like a subscription business. More users, more revenue, more terminals, more cash flow. On paper, it looks like the crown jewel, but Starlink is still in an aggressive expansion phase. Infrastructure costs are massive, maintenance is ongoing, competition is not standing still, and margins that look strong in isolated reports can compress fast when scale meets reality. But that's still not the real problem, because there's a third layer: adjacent technology bets, AI positioning, strategic assets tied into the SpaceX ecosystem that aren't always part of core rocket operations, but are financially and strategically connected through capital, leadership, and long-term narrative. And this is where valuation stops being about fundamentals. This is where it becomes about stories. Because markets don't price what exists today. They price what might exist later. And that gap between what is real and what is imagined, that's exactly where things break. But that's still not the real problem. Here's the part almost nobody's talking about. Because IPOs are not just about companies. They're about timing, liquidity, and who gets in early versus who gets in late. In almost every major IPO, the pattern is the same. Early investors reduce risk. Private capital exits partially, and public markets absorb the story. But with SpaceX, the scale changes everything. Because demand doesn't come from just retail investors making conscious choices. It comes from index funds, ETFs, retirement accounts, passive capital that doesn't choose. It just follows rules. Once a stock enters major indices, buying becomes automatic. Not emotional, not analytical, mechanical. And when demand is mechanical, valuation discipline weakens. Because price is no longer discovery-driven. It becomes flow-driven. And flow-driven markets can disconnect from fundamentals faster than most investors ever realize. That's not fraud. That's not manipulation. That's just the structure of modern markets working exactly as designed. And in that structure, the last buyer always carries the most risk. So let's be honest about what's really happening here. A great company can still be a terrible investment at the wrong price. And with SpaceX, the price is being set before you ever get a vote. Private investors got in at the ground floor, institutions positioned early, and by the time this hits public markets at $1.7 trillion, everything is already priced for perfection. No room for delays, no room for margin compression, no room for the messy reality of building something this ambitious. SpaceX is revolutionary. That's not in question. But in markets, the buyer at the end doesn't get rewarded for innovation. they get rewarded for timing. And timing is where most investors lose. Stop focusing on companies. Start focusing on narratives because right now, the SpaceX narrative is one of the most powerful forces moving capital in modern markets, which is exactly why it deserves scrutiny, not hype. Scrutiny. If you like videos like this, subscribe because we're going to keep breaking down the companies where the story is doing more work than the numbers. And that's always where the real risk lives.